Hi everyone. I'm Toby Turtle, the official mascot of STO Summit Spring 2025. We're excited to share the recorded sessions from the world's leading summit on security tokens and real-world assets. Hey Matthew Schneider, over to you.
Tim, I was a little worried about you. You just showed up at the last minute, but we are ahead of schedule, so no one is to blame. But this is great. I see everyone here. So without further ado, I'm going to go ahead and get things started. Of course, we know that each of these are going to be clipped. So for folks tuning in on YouTube for the first time, good morning, afternoon, and evening. We're really glad that you're here. This is the International Security Token Association STO Spring Summit. I'm Matthew Schneider, chairman of the organizing committee for ISTA and Building, CEO at Building Inc. I'll be the moderator for this panel, Compliance by Design, Legal Frameworks for Security Token Issuance. Joining me on the stage, we have a few fantastic speakers. I'll run through their names. We have Timm, we have Elisenda, you're gonna have to correct me on that. Jorge, maybe Konstantin will be joining us. I know that he had some work prior, and then Thomas, who just presented for us. What we'll do, we have about 40 minutes to go through this, maybe a little bit longer. We'll do 30-second introductions of everyone, and you can pronounce your names correctly because I probably did not do justice for everyone, and I even left out last names for that reason. And then we'll allocate about 7 minutes to each question. We have some compliance and risk questions that we'll go through. So we'll kick off introductions with Timm, if you'd like to take it away.
Thank you very much, Matthew. So, hello everybody, my name is Timm. I'm one of the co-founders and managing director at Particula. Particula is a specialized digital asset rating provider covering all kinds of digital assets, but mainly focused on tokenized assets. And compared to the traditional credit rating agencies, we are not only focusing on the credit risks associated with the underlying, but we are covering a real-time and holistic approach. So we are assessing all major product features across all levels. So the issuer, token, and the underlying asset level, and mainly focusing on the financial stability of all parties involved, the economic design, of course, also legal and compliance, as well as technical integration and security. Thank you very much for having me.
And next, I'm going to get it right this time. Elisenda.
You're pronouncing it right, Matthew. It's very difficult. Yes, my name is Elisenda Fàbrega. I'm the general counsel at Brickken, a company based in Spain. Basically, my day-to-day, in order to understand my background, is to provide legal assessment to the company internally. Okay, not to the clients, but to the company. What it means is to my colleagues of marketing, sales, and other departments. What does Brickken, or what is my day-to-day? You know, what we do at Brickken is basically we are a SaaS provider, okay, a software provider that allows companies to tokenize directly their assets. Okay, imagine that you have a company and you have shares and you want to sell part of your equity. Okay, in this case, you can use our software. Okay, and basically we try to do our software easy to use for anyone that knows or doesn't know how to use blockchain. Thank you.
Perfect. And Jorge?
Hello, I'm Jorge, and I'm here in Latin trying to intersect all the organizations talking about these type of topics from North America to South America. I studied liquidity pools master and master in tokenization in Spain. And right now, the focus is on legal framework. I'm not gonna show you guys my project yet.
Great. And it looks like Konstantin was not able to join us, so we will finish with Thomas, if you'd like to introduce yourself again. You are muted, though.
The easy things. Thank you. Sorry. No, anyway, I forgot to actually say that I'm the founder and the CEO of Assetera, sorry. And I have a banking background. I have spent 15 plus years in corporate banking, then moved to Challenger Bank. We sold the Challenger Bank 2017, moved clearly from VC to PE, and then it became boring. in a way that we had to start something on our own, which we did with Assetera 4 years ago. And yeah, and here we are, the first, or one of the very first, not to be too arrogant, in a way of a decentralized EU-wide regulated trading for real-world assets on-chain.
This is great. We have a great lineup of companies all across the world and with diverse backgrounds and experiences when it comes to understanding risk, compliance, and how it all has to play together. So that said, for the first question, I want to unpack how we're actually rethinking compliance in some ways when it comes to tokenized securities. And so my question to all of our speakers, and anyone is welcome to jump in, and then speakers can follow up, just take turns. We'll have about 7 minutes and I'll indicate when we move on. But the first question, I'm wondering what assumptions about compliance and investor protections are being challenged by tokenized securities? And why does it matter now?
If you want, Matthew, I can start, and then my colleagues will probably provide more background and insights. But it's a very good question, and I would like to talk not only about a legal perspective, that basically is my main day-to-day, but also from a practical perspective, okay? From a legal perspective, I think there is a lot of misconceptions around tokenized securities and how compliance applies, okay? And if it changes or not. From my perspective, at the end, an asset is an asset, okay? And the applicable laws, for instance, in Europe, would be the same. Okay, depending, of course, if you create a digital twin or not, but in general terms, if you are creating a security, MiFID II will apply, if asset reference token, MiCA, etc. No? But it's more from a technical or practical perspective that I see tokenized securities is affecting compliance and investor protection, no? Because with platforms and tools, okay, that some of my colleagues already talk about them, or Brickken, for instance, also, you provide to the investors and some tools of compliance that allow better compliance. No, for instance, we know some KYC providers that allow you to apply in a better manner AML practices that are normal, in fact, based on MiFID and AML regulations, but from a practical standpoint of view, it's easier to apply them, no? So, I don't know, SAMSAP or other platforms that provide KYC services and also investor protection. You have more traceability on blockchain. And of course, there is risk also, but if the providers, as some of us, we are here, technological providers, we take into account to be compliant, I think that how it's going to affect or how we can rethink is that in a practical manner, we can provide better compliance and investor protection if we do it right.
I guess one of the major aspects, and thank you very much for making the start, Elisenda. Yeah, I guess we should also focus and differentiate between the status quo, which Elisenda outlined already, and the status or the goal we are working towards. Yeah, so when we are thinking tokenization through, we are talking about the possibility to move assets across borders, across ecosystems, and across providers. Yeah, and I guess this is really something which is changing the whole compliance procedures right away, because even when we have certain regulatory frameworks in place, they are still very fragmented. So when we currently look at the global market landscape, we have over 40 different regulatory frameworks, and we are clearly lagging of different standards when it comes to KYC and AML, but also other compliance metrics. So when we are currently looking at the landscape of issuers that we're assessing, we do not see this kind of clear path that issuers are following, and also the implementation of compliance procedures is varying a lot. So we have providers that are providing manual KYC, AML procedures. We have entities that are automatically incorporate that into the smart contract. We see providers working with whitelists, with blacklists, and of course also based on the regulatory requirements that we are seeing in their regime. So I guess one of the major challenges and how tokenization will change the status quo or the requirements is definitely over time when we are developing towards this kind of vision that we can move assets freely across issuers, across regulations, and also across ecosystems. And I guess this is also the main challenge, which we should take a little bit later today and other aspects when it comes to legal and compliance metrics.
Let me actually make a point here from the regulator perspective, because they are, I mean, 3 years ago we had nothing on the VASP, meaning our virtual asset, right? Then certainly all over Europe and every country we had a VASP license in place. And in Austria, we had 26 VASP registrations, I think 2.5 years ago. Now we have 12 or 13. So the regulator was, of course, making up in a way of giving the opportunity on one hand. On the other hand, they were indirectly also trying to understand the market, because you had to actually prove that you are, by offering custody, you're having Fireblocks or any other SOC to certify the software in place. And I think from the 26 to the 12, you see actually also that the regulators have been catching up with the MiCA as a European regime. I think it should be more aligned country by country. However, what we see throughout Europe under the MiFID regime, or for example, under the banking law, you have differences in the countries, right? This is something in the past. Banking, online banking was made for one country, full stop. You had the different local requirements, maybe on top of ESMA. However, what we are facing right now is a European market where you can have either an advantage because of the regulatory execution of the respective laws, or you can have a disadvantage. Just simply when you speak about onboarding, which is the first moment of truth by onboarding new clients. In Germany, as an example, you still have the video, right? You have to have from a law. In other countries, you have simply the full digital online chain, and not needing to have this video chat, because this video chat, I think, is. But I think it's. On the other hand, you had for security token in Germany, you had a special law by actually trying to get the proper framework for developing a niche, and then hopefully also adjusting over time. So I think number one, the regulator need to protect investors. As you said, Elisenda is of getting the, I'm not saying the black sheeps, but those who are actually not offering a proper service, they have to be taken from the market. And on the other hand, with MiCA, and even also we see with the DLT pilot regime, the regulator does not look at speed. The regulator looks at proper execution. What we see, for example, with our 2 licenses, and we had already inspections in our offices 2 or 3 times. They are really taking it serious. Maybe in other countries not that serious, but we have chosen Austria because certainly we are from Austria, and second, also the reputation of the authority here. However, sometimes it can be really a pain in the neck when we talk about compliance and AML. So sometimes I would love to be in Cyprus or Malta.
So we know that regulators don't want to move too fast because security and protections are priorities. Do we feel, though, that they're moving at an okay rate, or are they perhaps being a little overburdening in their expectations and restrictions? If there's any strong opinions on this.
I think that before going forward, there's something to contrast here between Europe and Latin American regulatory framework. In Europe, we can see that the regulatory framework is super maturity, and in Latin America, we're having flexibility. So we all know you guys have well-established legal pathways, but they're often expensive, slow-moving, and over-engineered versus Latin America, that the frameworks may be still evolving, but give us the opportunity to build agile, practical structures, especially in jurisdictions like Salvador, where laws are designed for innovation. So what's the real benefit behind this? That we have faster deployment, lower legal costs, high impact projects that can tokenize real assets from housing to energy with global compliance in mind. So I think LATAM is not behind. It's just building differently. And in many ways, flexibility is an advantage when talking about launching new projects. And something to comment, in Salvador, they're not only protecting investors, so they're having tax-free advantages if you keep the money inside the country. So I think it's worth it to mention it before going forward.
And I guess maybe to add here, so I also really like the approach El Salvador was taking. Yeah, so I guess it's a very lean approach. It's a harmonized approach and also an approach that is supporting the local ecosystem. But I guess generally speaking, especially comparing Europe to LATAM, I guess we can definitely state that it's always good to have regulation in place without any kind of gaps within the regulation. Yeah, so even when it's over-engineered, it places a lot of burden. It also creates the situation that only high-performing providers will stay in the market. And of course, we are also seeing this is the other side of LATAM. Yeah, where we were just assessing one provider out of Mexico, and they are operating on an exemption from the banking law. Yeah, so there are not real clear frameworks how they are operating. It can be the case that the law will change in the next 2-3 years, which creates a lot of uncertainty on the investor side. And of course, also based on how the product is engineered and how claims are structured, especially looking at the ownership rights that are transferred with the token without clear regulatory frameworks in place is always a challenge for investors. Yeah, so generally speaking, I guess I very welcome the situation that it seems to be the case we are moving forward globally. Also the US entering the race, creating certain guidelines for market player active. And even if some regulation might be over-engineered, it creates a situation that very good offerings will stay in the market. And overall, I have never heard an investor, at least when he did his due diligence, saying, oh, here's too much compliance and general due diligence information available, I will not do it. So I guess the main challenge for investors is to not have clear regulatory frameworks, to not have those guidelines, and leave question open in the product design.
I think the speed is maybe not the right catalyst here, because certainly the regulator, they are catching up. I mean, some of the regulators here, or the people working with the regulator here in Austria, they know Chainalysis up and down. They know Fireblocks, know all the other providers, so they have a good understanding of what we can be doing. I think what's though a bit a burden sometimes, that the regulatory costs and what you just mentioned there is becoming extremely high. So if you look at Malta, Cyprus, or Latin America, in the Central Europe, the regulatory costs are extremely high, not the capital, but basically you have to have already Chainalysis, Fireblocks, an AML head. You start with 100K minimum cost for just receiving a license, and then on top you need management. On top you need certainly also the system and the operating costs. So I think speed is. I would rather say we are in a global business, even though with security it's a bit more difficult based on the or because of the jurisdiction than with crypto. Crypto is like jumping from A to B to C. Like currently what we see, Dubai is obviously generating for all other jurisdictions a location disadvantage, because there is low volume today, but anyone is moving there. And what you can definitely see, this is again, this is a Web3 hub, yeah. And then the question is, why not having an account with a Dubai-based licensed company? And on the other hand, in Europe, you're gonna have, based on or because of MiCA, because as part of MiCA, you have to have a license, a MiCA license in Europe to offer your services in Europe. So there's good and bad. You have the choice, right? You can go to different regions and start a business there. It's difficult with security token. At least it's a bit more difficult than with crypto. So as you said, if I think Timm or Jorge said, it's there will be only a few left after the consolidation, because it's again it's investment, it's cost, and even also with security token we don't see this return now. So hopefully by end of next year. But yeah, so it's a kind of it's a cost intense operation by being just in security token only.
The multi-jurisdictional approach adds another layer of complexity to the responsibility of creating smart contracts in the first place, because of course you want to design compliance into them, which is the nature of the panel here. You also want them to be scalable and flexible, and that becomes even more pertinent when you are working with almost different sandboxes that set different expectations. So what does it look like to actually design a smart contract that would be used as a security token that satisfies this almost Venn diagram or triangle of needs?
Well, I can start this one. I think how it's now structured is difficult because the standards that we have, okay, are very strict, or very how can I say, they are not modular. Okay, they have been created in a manner, and then we structure them through smart contracts, which is fine. But maybe first of all we have to understand if it's needed a standard that it's more modular based on the asset that is being issued. No, for instance, if it's a security, there are several securities. There are several financial instruments that are not securities and have specific characteristics, okay, that you have to replicate in the blockchain, no, if they are fungible, if they are non-fungible. And first of all, we come from a situation that we have standards, like several standards that are adaptable to several assets. And of course, how we can structure a smart contract is not easy, because as you were saying, Matthew, I don't know if you were talking about sandboxes of Europe and etc., like sandboxes of proofs, or you were talking about sandboxes of companies. But it's true that each jurisdiction has its own sandboxes, and then we have general sandboxes where simulations are done, no? The European sandbox, for instance, of DLT technology, not the pilot regime, but the DLT technology one. And it's true that we have to have so many things in mind, no, when we create a token and we create a smart contract based on it, how or what AML compliance measures we want to have, if we want to have them in our platform, if we are a provider, or if we are doing the issuance directly, to what buyers we are going to send or sell, no, as Javier was talking about Salvador. Of course, Salvadorian laws are specific ones based on the asset that you are issuing, but you also have to know the European ones, no, and apply to them, and so compliant general ones. And my recommendation to any listener here is that if you want to issue a token, always check all the laws applicable, all the guidelines and sandboxes that have been done to the places where you are going to issue and where you are based, and try to be as compliant as possible, as more better. If you are based on Europe and you are going to issue to Salvador, maybe try to apply European laws, because Jorge was explaining that it's a little bit more lean on compliance. I'm not expert in Salvadorian law, then I cannot talk about it. But I think Javier, Jorge is asking something. That was all from my side.
No, finish. I want to add something after you.
Okay, because probably you want to say something about the Salvadorian law. Basically, this.
No.
Okay.
No, I believe that structuring a truly global tokenized asset is not just choosing the country that fits the best or the legal system. It's about orchestrating the best of each one. I mean, if we're having a panel being in different countries and having different legal frameworks, but talking about global tokenized assets, it has to be like a structure where we might have European frameworks for investor confidence, Latin American assets for growth, and US entities for financial access and legal strength, right? So it's about building a structure that globally friendly, local, relevant, and future-proof. I think we need to do like synergy between all of them because, as you said, consolidation will take out a lot of people because I don't know anyone in real world assets right now having the stronger profits. Everyone is investing in the next 5 or 10 years to be the first one in their local in the locally framework. But at the end of the day, when we do synergies, we will evolve together, right?
I guess what's really challenging, and maybe starting off with this kind of advice to always look at it from a holistic perspective. Of course, there are certain aspects in the legal contracts and the smart contract design that needs to be considered, but there are actually also more, especially in the current market environment, more metrics to look at. So from my perspective, I would start with this kind of comparative analysis between the legal frameworks and harmonize this with my understanding of investor demand, actually. So what we're currently seeing is that we have a supply overhang when it comes to tokenized assets. So everybody is in competition around investors, creating or attracting liquidity for their offerings, and the market stage is still pretty nascent. So from this perspective, I guess a good advice would be to look at the analysis of the different blockchain ecosystems. So where on which ecosystems we are seeing the most traction, the less hurdles for adoption, and also do the same in regard to the smart contract functionalities. So we are seeing different standards out there. We are seeing standards that are more tailored for certain asset classes, because it incorporates, for instance, payment flows more naturally and provides integrated KYC AML procedures. And I guess one additional advice based on the issuers that we are looking at is each issuance is highly individual. It depends a lot on your skill set, the asset class you're looking at, and the regulatory framework that you're going to leverage. And there is no right or wrong. So for every framework, there is a certain use case. And I guess one good example is actually one issuance from Blockstream and Stocker. So they have created tokenized exposure to Bitcoin mining activity. And many people are not aware of this kind of offering because they have decided to bid on Liquid, which is a Bitcoin layer 2. The integration of Liquid into the broader market ecosystem, Thomas is already nodding, is very challenging from a technical perspective. And they have different features compared especially to EVMs, but they have created an offering with actual demand with a regulatory framework in Luxembourg, which is established and recognized from investors. And based on that, even building on a more nascent blockchain ecosystem, but with natively integrated KYC, AML procedures designed for institutional investors, they have achieved over 600 million in assets under management in the last 3 or 4 months. So it's a very high adoption rate, and nobody is aware that this is actually, I mean, they are in the top 10 from assets under management when it comes to tokenized assets, now even top 5.
Maybe it's really a pity, and I don't understand why these guys are having chosen simply the wrong blockchain. But as you said, it's every token, every smart contract is individual, and you have to approach each project different. Many are coming to us, and few things are important. One is the jurisdiction. Second, the target group. Are you distributing to retail investors and or institutional investors? What kind of financial instrument will that be? Is it just the asset and you have a digital twin on chain, you're an SPV and you are generating equity or a bond? So there are many, and the financial instrument, there is not one financial instrument, different kind of financial instrument. On the one hand, good to have different financial instruments, so you're going to get the right financial instrument for your token. And on the other hand, issuers are certainly sometimes a bit, how should I say, but well, I don't I have no idea what I should do. I want a token. Yeah, I want a token and I want to distribute the token. But it's also an education, it's a consulting with the token issuer to make sure that you define the right volume, define the right financial instrument, define the right target group, and even also understand how the distribution will work. Is it distributed through your own website plus different other brokers throughout Europe or others? We are, for example, taking a few from the US, even also being involved in Cayman and this stuff. But if they have a Reg S in place and are distributing to institutional clients, then we are fine on having this on our secondary market trading. So I think it's all about the issuer understanding what product, what investment product he wanna distribute to what target group. And unfortunately, most of the time, that's not clear for the issuer, but it's good to have this one. Otherwise, we would not have a job to be done in order to make sure that the issuer is getting the right investment product on chain, distributed and available for trading.
There's one common point that I picked up on, which is that there isn't necessarily a right answer, and there isn't supposed to be. There's supposed to be diversity of investment products, and as long as the risk and reward of each one of those is thoroughly understood, then all is well. We shouldn't be trying to normalize outputs or products because we have different goals and ambitions in what we're trying to accomplish with our portfolios. Thomas, looks like you want to say something?
No, yeah, perfectly summarized. I mean, couldn't have been doing it much better, but it's yeah, it's perfect summary.
Well, this segues into our third question, which is all about actually assessing that risk. Now, we've touched on a few different topics here, different blockchains and the amount of liquidity available on them, different jurisdictions and the regulations, the asset classes that we're dealing with, and then the financial instrument representing something in that capital stack, all of which adds different layers and variables in how we're calculating the risk and reward of those individual investment products. So from asset risk to instrument structure to the smart contract, how do we assess that risk in a way that's at least mutually and globally trusted?
Yeah, happy to take this one or start with this one. So one of the major things that always becomes clear in conversation when I'm talking to various people is that actually to many persons, it's not clear that tokenization is simply changing all major product features. Yeah, so independently from the underlying asset, whether we have a former analog asset, a single asset, basket asset, or already digital asset, when you tokenize those assets or add additional smart contract layer, you're changing all major product features. Yeah, so we were already talking about new regulatory frameworks. We have new valuation mechanisms for those tokens. We bring those tokens differently into our balance sheet, into our tax declaration compared to the underlying asset. And of course, we have a complete new operational infrastructure with unique risks. Yeah, and what we can currently observe in the market is that the same underlying asset, like US Treasuries, for example, is tokenized by different providers out of different jurisdictions with different tax stack and ownership rights. Yeah? And the consequence simply is that when investors are currently looking at the space, they can see, maybe we can make an example utilizing BIDL from BlackRock. So they are looking at the market. They say, okay, I want to build tokenized on-chain exposure to the BIDL fund. Yeah, I look at Securitize, which is the technological provider, and ATS for BlackRock. Maybe I want to build exposure there. Then I'm seeing, not anymore, but at a previous date, Ondo OUSG bagging their token 100% to BIDL, and other providers like Matrix Docs and so on and so forth, Midas. So I'm, as an investor, looking at the space saying, okay, I have one underlying asset. I have 5 different tokens that I can build exposure through, and they are launched on 6 different blockchain ecosystems. Yeah. So this already gives an indication, because also the terms are different on each blockchain ecosystems, because the ecosystems would like to attract investor and good offerings. Yeah, so they are covering transaction fees, they are giving grants, and so on and so forth. So it's really hard to decide for institutional investors which kind of asset they would like to get exposure to. And on the other hand side, these are complete new due diligence processes. Yeah, so you need to harmonize on and off-chain data. You need to combine initial assessment with ongoing monitoring. And in the best case, we are operating in a 24/7 market, which also requires 24/7 risk monitoring. And this is really the challenge that we are seeing, that investors need to perform holistic assessment along those unique product features. They need to clearly understand the tech stack, which not only covers the smart contract and the functionalities incorporated in the smart contract, but also the blockchain ecosystem and the specifics around that. And there are also additional metrics many people, especially when they are looking at TradFi instruments, are not aware of, because there was no necessity in the past to assess those metrics. Yeah, so one example would be, for instance, in digital assets, we definitely need a point of sale assessment. Yeah, so what we can see in the market is that token issuers are listing with different trading facilities, and sometimes the terms and conditions of those trading facilities are overruling the terms of the issuer. So they are changing product features. And when we look at offerings, currently we have one in assessment. They're also launching out of El Salvador. They are listing with an exchange there. So the primary issuance is done via the issuer, secondary trading via the trading facility. And the trading facility employs new terms. And for instance, one additional metric that they have within their terms and conditions is that there's no insurance coverage for all funds on this trading facility. So it becomes increasingly important to think due diligence and risk assessment from a holistic perspective, not only assessing the token itself, but the issue and the respective ecosystem. So tokenization provider, custody provider, on and off-ramp solution and trading facilities. And of course, also the underlying and how the underlying is connected to the token from a legal, but also from a technical perspective, to have this overall view. So only assessing credit risk with the issuer and with the underlying is not sufficient anymore. I guess, Matt, you're muted.
Yes.
That's my bad. Elisenda, do you have a question or a comment?
Well, yeah, I was going to make a comment to what Tim explained, that I agree totally with it. But at the end, he said something that now I don't know if what I understood at the beginning was that or not. But he was talking about the asset underlying, and that you have to separate the underlying asset to the asset that you created on the digital sphere, no, as we can say. And I think at the end he said it what I wanted to point out, but just for clarifying purposes, and also following what Thomas explained before perfectly. But it is true everything that Tim said, and of course if you are changing with the smart contract and technology the token that you are creating, like its characteristics, okay, you are not replicating the asset 100% on blockchain. It's true that that asset or that digital representation should be assessed separately. Okay, you have to do the legal classification of it. But if you are capable of creating a digital twin of it, then you have to follow the rules that you were following before. For instance, if you are creating a share and you are perfectly capable of replicating that asset as a digital twin, then you have to follow, of course, as Tim said, depending on what you are using, no, if custodians or whatever, but also you will have to follow MiFID II, okay, just for clarification purposes.
I guess this is a very good point, and thank you very much for the clarification, Elisenda. The ownership rights are actually a big topic. So it's not only about how you're designing the token, but also which kind of tools you have in your regulatory framework to assign ownership rights. And we are currently differentiating between 3 different options. So I know the digital twin saying, which is also used in various sandboxes, but the particular internal, so to say, version is that we are assigning if it's either a no-claim token, a relative rights token, or an absolute rights token. So no claim, you're only buying the token. You do not get any kind of, for instance, liability against the third party and no ownership of the underlying. And this is exactly what relative and absolute rights token are all about. Yeah, so it's a huge difference, and sometimes it's tied to the regulatory framework, because especially issuer do not have the opportunity to attribute absolute ownership of an underlying to a token based on the regulatory framework, and therefore they can only, so to say, give a liability against a third party. Usually it's the issuer taking the asset on their own balance sheet, or creating an SPV or something equivalent to create at least a third-party claim. And when we're talking about absolute ownership, then of course the investor get exposure to, for instance, the underlying fund share, and also has the opportunity to directly approach, for instance, the custodian to exchange the token against the physical good, which can be a fund share, commodity, or whatsoever. So this is actually a very important point also, which needs to be considered from investors, which kind of ownership rights and claims are transferred with the token.
Totally agree.
Then I guess the only thing which is critical here is the no claim token, right? Because I haven't seen yet from a legal construction that we had issues, of course, not with ownership, of course, if potentially with a bond, which is an SPV, and you're buying the token and the bond is the underlying, you might have issues because of the issuer, but not because of the legal construction. But the no claim is certainly something what we are not supporting. Why? Because as a MiFID II company, we also need to have, we also need to make a product governance by each token, meaning we have to read each prospectus or each regulatory paper and have to make an assessment that we are, what are we? Yeah, that we kind of sign off that we shall distribute this token to our customer base. So by that, it's that's I would say that's at the point of sale. Yeah, so at the point of sale, we are taking our responsibility, not taking any no claim. We're only doing this kind of a bond and ownership stuff in a way that we read that. And apart from investor protection, we certainly also need to make sure that we are in the, how should I say, in the field of our service capability, right? Because some MiFID licenses, they just offer equity bond, for example, and then they are not able to offer an alternative investment fund open-ended, for example. So the product governance, what we do is for the regulator, basically, on the one hand, that we are allowed to do that, and secondly, that we also in the scope of our license to provide this service, or to provide this token to the customer base. So I think that's kind of a point of sale assessment, but we all know that this is different in around the world. Treated differently.
Certainly. And real briefly, Lawrence, glad to have you in here, but if you'd be able to mute your mic real quickly. So building off of the investor protections, if we were to take the lens and perspective of the regulators, do we really feel that the frameworks that we have in place are protecting investors, especially in potentially higher risk cross-border tokenized economy? Or is there a lot of potential gatekeeping, to use a layman's term, of capital and deal flow? Which, where on the spectrum do we feel that the regulators are currently sitting? And if we disagree with it, how would we make some adjustments to that?
I guess the challenge that investors are currently facing, also when it comes to the consideration of gatekeeping or how we are designing secondary market access, and when it comes to investor protection, it's all about they need to harmonize their understanding of the terms and conditions of the issuance, the regulatory framework under which the token was issued, and the smart contract implementation, and not only initially assess it, but ongoing monitor it. Yeah, so for instance, we are seeing many issuances where within the terms and conditions, the issuer has the right to completely modify the terms without any kind of notification period. Yeah, so you can wake up and your token terms are completely different. You have a different product with different rights, and then we cannot talk about investor protection. Yeah, and I guess this is the main aspect. We all need to get a better understanding how we can harmonize our understandings, how we can also create monitoring solutions that, for instance, enable the situation that we clearly understand, okay, within the smart contract, all regulatory requirements are fulfilled. So for instance, when we're looking at the MiCA regulation, it's necessary to have a freezing or pausing functionality within the smart contract to stop the operations when something bad is happening. So I guess this is really crucial to have this kind of monitoring in place, not only when it comes to smart contract vulnerabilities and the point in time, what the big smart contract auditors are assessing, but ongoing monitoring and translating, especially the technical implementation, into a language that investors understand. And I do not think that the regulator is gatekeeping. So far, we have the most fluent exchange with representatives from the German BaFin, and I share the understanding that Thomas outlined a little bit earlier, that they have a pretty clear understanding in which direction we are going. They are very knowledgeable, and they also want to drive the space forward. So this is really the mindset that they are operating in. They want to solve the open questions, and they want to create a market infrastructure where both the issuer and the potential buyer has clear rights and obligations outlined. So I do not think that anybody's gatekeeping at the moment, but it's of course very challenging to have this kind of differentiation, mainly between primary issuance and secondary trading. So what we are also often seeing is that issuers are creating international partnerships. For instance, they are starting issuing out of Switzerland, for instance. They are leveraging Jersey in parallel, and then they are collaborating with a US-based ATS for secondary market activity and getting exposure to retail. So it's really complicated. It's a workaround. It creates high fragmentation and also higher costs, which brings us back to the point Thomas made, that you actually need to have deep pockets to design a good offering. And I guess this is the challenge. Also, international committees need to think about, work on how we can create this kind of standardized infrastructure so that we do not need too much workarounds anymore.
However, one point I need to make here, if you're going to look at the traditional finance world, we do not see that global vision, what we are intending to have with a blockchain around the world. So it's we are speaking about kind of roadblocks or potentially limitations if you're going to look in different jurisdiction or distributing in multiple jurisdiction. But I mean, if you want to trade on a New York Stock Exchange as a normal broker, then yeah, you're going to have different intermediaries. You have to have partners and so on and so on. So even with the blockchain, we have a great tool, a rocket underneath, where we simply need to define the use cases and somehow compliance on chain, that we are not copy-paste existing market infrastructure from traditional finance, at least kind of take out intermediaries and hopefully be more efficient by using the blockchain than we are doing business in the traditional finance space.
Yeah, I totally agree with Thomas and Tim. What they said is spot on. But also, I will like go a step behind. Like, we are talking about tokenization in general terms, but there are several sectors inside tokenization, and we are not thinking about that. Like, for instance, the automotive sector, no? It is a very big sector that includes several subsectors that they have their own specific jurisdictions, they have their own specific sectors. And what we are trying to do is that, first, we are trying to regulate everything as it is equal, which is not. There are, for instance, as Thomas was explaining, no more TradFi, DeFi intersections. There are Web3 completely out decentralized, and we cannot do, or we cannot try to govern a custodian as it is a software provider. It doesn't make sense. for instance, DORA. No, now it's more applied to software providers in that sense, to financial or issuers that want to issue financial instruments, and that makes sense. It, for me, shows that the regulator is on hands on the task. They want to regulate, they want to be open, as we were talking before, no, about the sandboxes or other actions, no, DORA, for instance, that they are including type of companies similar to financial ones. But it is true that trying to create, first of all, a general framework doesn't make sense. We have to analyze each sector, each and the regulator is going to understand on the years get past. Like each year, I think that the laws are more spot on, and they have more bear more in mind, like the assets, the kind of assets, the kind of providers that exist in the environment, and I think that that is what it's going to happen, no, in 5 years or more, no, more sectoralization. I don't know how it's the name, but
And maybe to add here one last point from my side, and maybe also an open question into the round, if somebody is aware of any kind of solution in the market. I guess, of course, it's always the combination of private companies and the regulator driving developments. And one of the major aspects, especially when it comes to KYC, AML procedure, huge gap in the market is actually that when I go to Thomas and his trading facility, I need to perform KYC, AML. Then I want to go to another, I need to do the same. Yeah. So every time I want to get exposure to a certain asset, I need to perform KYC, AML procedure, maybe also different procedures like Thomas outlined with video ident, so on and so forth. But when we are following the vision that in the future I hold an asset on Assetera and I would like to transfer it onto another marketplace, as a customer, I would prefer if I do not have to perform KYC, AML all the time. Yeah. So what I'm really waiting for, and I haven't heard any kind of sufficient solution or any kind of ideas how this can be solved, but a global registry where you can register for KYC, AML procedures, and they are sharing the information with different entities so that we have the situation that an entity can trust the KYC, AML procedure of another entity, which is definitely not the case in our current situation. And like I mentioned, I do not know if there's even a possible solution for that, but this is really a missing piece. Yeah, so everybody is working with different whitelists, blacklists, different procedures, and nobody can utilize the procedures already performed by other entities.
Yeah, but
I think this. I'm not sure if an entity of a global or if a EU regional entity is able to do that, because it's then again fully centralized. I think what we will see though in the near future, all well, in Europe, basically you have to have a MiCA license, right? They're offering cryptocurrencies. A MiCA licensed entity is a qualified third party like e-money institution and a bank. So you can rely on the KYC of a MiCA licensed company. Having said that, you can actually make bilateral links between different kind of companies. I'm not sure if we will see, I mean, the online identity with the compliance features, which is definitely great. It's like the passport carrying around on the blockchain. That's a perfect idea, but I think I have heard this for 10 years and we will hear this in the next 20 years. Yeah. And I also believe that one thing on the regulator, at least in the crypto, in the CASP, MiCA department, I think they are all below 30 years. The AML law and the AML department, they are 40 plus, 50 plus, and they are super complicated because they just don't understand how you're gonna make an AML into a blockchain or into a online operation. But in the WASP department, they are 30 below. And if you're gonna say something about crypto, yes, we know. They even ask you how was the Paris conference, because they also goes you on LinkedIn, yeah, what you're doing and then what you're liking, what you are doing in the marketing, etc., etc. So I think overall, but the question was also earlier, I think if I think the European regulator tried to be business partner, at least in the cryptocurrency space, which is what we need, because they're also challenging us to give us advice, to give us support in what we are doing, which is highly welcome. And on the other hand, yeah, I mean, coming from the finance world, I do understand regulation, why we need, again, the good example of bad, however you see it, was in Austria, where we had 26 WASP, from 26 down to 12. We also had some who are actually, yeah, they have had nothing. They had no procedures, no policy, nothing, and have been operating as a WASP. So I guess this also is important to get this regulated in a way of investor protection. I repeat, but there's certainly, just imagine you have lost money with the FTX default as an investor large, then yeah, then it's something you would really care for. And yeah, and once again, on the onboarding, that's all this KYC, KYB, AML, even also when you're gonna have to have a wallet whitelisted to the KYT with the respective tools. That's something some say, okay, yeah, we're gonna do this business, fine, we don't care. And some have a bit tighter, high risk, medium risk, low risk, which is fine. Diversifying the risk and make sure that you are not, that you are within the so-called framework. Yeah, that's somehow, I think that's more important.
I really like what Thomas mentioned about portable compliance or Web3 passport. I think that concept of on-chain identity moving across platforms is so powerful.
But it will not be a private company doing that. That's and having a I don't know, having a government, or having the EU, or I don't know, having Donald Trump or whatever you call doing that. I think that would be a default. Yeah, if it starts, maybe Elon Musk can
So
do
it's
that.
centralizing again stuff, right?
Exactly,
Or
yeah.
what's
But the one thing, we have a partner in the UK, and they are building an online identity very similar to what Tokeny built. And both companies are actually missing the compliance proof in the identity. And in fact, we can do that, yeah. But then we would be the tollgate. We would be the centralized tollgate where anyone needs to get his digital passport. Good for us because we get user. However, I'm not sure if this is a a doable setup.
I think this is going
Yeah.
to be like our personal AI agent just doing the filling of every compliance form we need to fill, right? So it's going to be like individually linked to the digital passport, as you're telling.
Elisenda, final comment?
Yeah, no, I just wanted to point out about what Thomas, Jorge, and Tim were talking about, no, about the question of KYC that is applicable to several. When you want to invest in something, you can use your KYC, but I think that it's very difficult. Of course, what Thomas said, if it's not privately owned, then it's another thing. But at the end, we have to understand that if you want to invest in a company, and depending on the asset and on the company, on the requirements, on the jurisdiction, you may have to be checked on sanctioned list, on PEP list, etc. Okay, and the requirements will be different depending on the jurisdiction. Then also what Thomas was explaining about the KYTs, depending on the company, depending on the jurisdiction, depending on several, also about the company that you want to invest, maybe they don't want you to have a wallet that has done, I don't know, 10 transactions or 11 transactions. They can assess that, no? For that reason, for now, I think it's difficult just because we don't have a general sanctioned list based on international, like it's depending on several things. And for that reason, I think it's difficult, but it's true that there are platforms that are KYC providers that allow you to share information, but you have to have the companies that are going to share, they have to have documents in place that are not smart contracts, that just normal documents, and then they can be shared. But of course, maybe then the other company doesn't accept if you want to invest in them because maybe you are not complying with the requirements.
Perfect. Well, that was a great way to wrap up this conversation. It's been, wow, 45, 50 minutes talking about compliance and risk, and a whole lot of knowledge and wisdom embedded throughout this from all of our speakers. So this is where we'll move on to the next session. But again, we appreciate everyone who has tuned in live, and then of course, everyone who has watched through the recording. So thank you to all of our speakers for joining us on stage today.
Thanks for joining us at STO Summit Spring 2025. Stay curious, stay connected, and remember, the future is tokenized.